ProPublica news outlet, the 25 wealthiest Americans pay tax at a far lower rate than the average worker. The website alleges that Amazon's Jeff Bezos paid no tax in 2007 and 2011, while Elon Musk, the founder of Tesla, paid nothing in 2018, claiming.
Isn't it bewildering how some of the wealthiest individuals on the planet, like Elon Musk, often end up paying almost no income tax? It's a fact that has left many people scratching their heads. How is it possible for billionaires to minimize their tax obligations to such an extent? Taxes, that unavoidable part of life that can seem like a never-ending puzzle. After poring over hundreds of articles, consulting financial experts, and deep diving into the strategies used by the super rich, we've uncovered a goldmine of information and tactics just for you. This is not about evading taxes, it's about understanding the system and using legal means to minimize the impact on your hard-earned money. Whether you're an entrepreneur, an employee, or someone simply looking to take control of their financial future, this video is for you. So hit that subscribe button and let's start right away. Lower your income. Taxes and income, they're like two sides of a coin, tightly interlinked yet conflicting. The less you make, the less you pay. Sounds simple, right? But lowering your income doesn't necessarily mean earning less. It's about strategically positioning your income in places where it won't be eaten up by taxes. Let's break it down. 1. Invest in tax-free municipal bonds. This one is a classic strategy employed by savvy investors. By putting your money into municipal bonds, you're supporting local government projects, and in return, the interest you receive is free from federal taxes. It's like getting a community service award in the form of tax savings. 2. Aim for long-term capital gains. Warren Buffett once highlighted how his secretary was taxed at a higher rate than him, and long-term capital gains are part of the reason. Holding on to investments like stocks for more than a year can help you qualify for significantly lower tax rates. It's like planting a tree and waiting for it to bear fruit. Patience pays off, literally. If you're always buying and selling, you might fall into a higher tax bracket.
10, Bosonic paid a nearly 36% tax rate. Buffett, who made $62 million that year, paid less than half of that.
3. Contribute to retirement accounts. Here's a tip that not only helps you today, but secures your future as well. By contributing to retirement accounts, you're effectively lowering your taxable income today and enjoying the benefits of tax-deferred growth. Think of it as a savings account with superpowers. The more you put in, the less the tax man takes now, and it grows without being taxed until you withdraw it later in life. 4. Utilize capital loss deductions. Made some bad investments? Don't worry, even those can work in your favor. If you've had capital losses, you can offset them against your gains, effectively lowering your income for tax purposes. It's like turning lemons into lemonade, financially speaking. 5. Work with a skilled accountant. Sometimes lowering your income requires a professional touch. Working with an accountant can unlock doors you didn't even know existed. It's like having a financial GPS guiding you through the maze of tax laws and ensuring you take the right turns to minimize your liability. Lowering your income for tax purposes is an art that requires strategy, patience, and sometimes professional guidance. Remember, it's not about making less, it's about positioning your money in the smartest way possible. Lower your debt. Debt is often viewed as a heavy burden, especially when it comes to taxes. If you find yourself stuck in the sinking sand of unpaid tax debt, don't lose hope. There's a way out. Strategies to lower your debt not only lighten your financial load, but can have tax benefits as well. Let's dive into some options. 1. IRS currently not collectible status. Imagine having a pause button for your tax debt collections. CNC status is just that. If you're struggling with unpaid tax debt and meet certain criteria, particularly if you're a lower income individual, you can request CNC status. This halts collections for about a year or even longer if your financial circumstances don't improve. It's like a financial timeout, giving you room to breathe and regroup. 2. Understanding CNC requirements. Now, CNC status isn't a magical wand that wipes away your debt, but it's a tool that provides temporary relief. Lower income individuals can obtain this status by contacting the IRS and fulfilling certain conditions, usually without extensive paperwork. It's about proving that paying your debt would cause undue hardship. Think of it as a safety net, not a permanent solution. 3. Avoiding garnishments and levies. The IRS can garnish federal benefits like Social Security and levy bank accounts for your unpaid tax debt. By understanding the rules and acting proactively, you can protect yourself from these actions. It's a game of strategy, and knowledge is your key weapon. 4. Work with a tax professional. Just as a skilled sailor navigates treacherous waters, A tax professional can guide you through the complex sea of tax laws and debt reduction strategies. If CNC status or other debt management tactics seem overwhelming, don't hesitate to seek professional help. Sometimes having an expert by your side is the best investment you can make. 5. The importance of communication. Keeping open communication with the IRS or your tax authority is crucial. Ignoring letters and warnings will only compound your problems. Responding promptly and honestly can pave the way for negotiation and solutions. It's like building a bridge over troubled waters. Connection is key. In the grand scheme of things, lowering your tax debt is about strategic planning, understanding available tools like CNC status, and seeking professional guidance when necessary. If you're in a tight spot, these strategies might be the lifeline you need. Tax deductions. Tax deductions. They're like the coupons that reduce your tax bills. Who doesn't love a good discount, especially when it comes to money owed to the government? Tax deductions offer opportunities to save in legal and strategic ways. Let's break down some significant areas where you can take advantage of these discounts. 1. Utilize capital loss deductions. You win some, you lose some, as the old saying goes. But did you know that in the world of investments, even your losses could work in your favor? If you've suffered capital losses in the investment market, you can offset your capital gains by claiming capital loss deductions. It's a way of turning a sour lemon into a sweet lemonade. This strategy helps to balance the scales and can significantly reduce your taxable income. 2. Contribute to retirement accounts. Planning for the golden years? Here's a golden tip. Increase your annual contribution limits for retirement accounts, like traditional IRAs, which can minimize your tax liabilities. The Secure Act made some significant changes, such as raising the age for required minimum distributions to 72 and eliminating age limits for traditional IRA contributions. It's like giving your future self a gift that also benefits you now. Talk about a win-win situation.
Cash.
Yeah, required minimum distributions are your 401k, your Roth, or your not Roth, your traditional IRAs. They require you to start taking money out at a minimum schedule so they can tax it. And it used to be 70 and a half, then it moved to 72, and with this it moves to 73. So
3. Working with a skilled accountant. Finding the right deductions requires an eagle eye. A skilled accountant or tax professional can help you navigate the complexities and uncover hidden opportunities to lower your tax bill. Think of them as your tax treasure hunters, guiding you to buried gems. 4. Creating a proactive tax plan. Remember, tax deductions aren't a last-minute scramble. They require thoughtful planning throughout the year. It's not just about finding the loopholes, it's about understanding your financial landscape and making informed decisions. Think of tax deductions as pieces of a puzzle. Capital loss deductions, contributions to retirement accounts, professional guidance, and proactive planning are key pieces that, when fitted together, can create a beautiful picture of financial efficiency and savings. So what are your thoughts on these strategies? Have you ever utilized capital loss deductions or maximized your retirement account contributions? Share your experiences in the comments below. Tax strategies. Tax strategies might sound like an abstract concept reserved for financial wizards, but trust me, it's something anyone can master with the right approach. By employing these strategies, you too can become savvy with your money. Let's dive into some major game-changing tactics that can make your money work harder for you. 1. Categorize assets into taxable, tax-deferred, and tax-free locations. Ever heard of the saying, a place for everything and everything in its place? It holds true for your assets as well. By categorizing your assets into these 3 locations, you can protect your wealth and even lower your effective tax rates. Imagine your money neatly organized into 3 buckets. Taxable bucket. This includes investments that are subject to regular taxation. Tax-deferred bucket. Think of your retirement accounts that aren't taxed until you withdraw them. Tax-free bucket. Certain investments like Roth IRAs grow tax-free. It's like having a garden where the fruits you pick are all yours. 2. Embrace technology. In this digital age, tax software can be an excellent companion in proactive planning. With real-time tracking and personalized insights, it's like having a mini accountant in your pocket. Warren Buffett, one of the wealthiest individuals globally, has openly spoken about the disparity in tax rates and how the ultra-wealthy can utilize laws to reduce their effective tax rate. Learning from this can provide real-world insights into how these strategies are implemented. Tax strategies are not just about crunching numbers. They're about understanding, planning, and making informed decisions. Whether you're a high earner looking to protect your wealth or someone just starting, these strategies can make a real difference in your financial health. Real estate strategies. When we talk about wealth and investing, real estate often takes center stage. It's not just bricks and mortar, it's a potent tool for financial growth. As Robert Kiyosaki, the author of Rich Dad Poor Dad, famously said, real estate investing, even on a very small scale, remains a tried and true means of building an individual's cash flow and wealth. So what are the real estate strategies that can assist in reducing your tax burden? Let's explore. 1. Depreciation deductions. Real estate is one of the few investments that allow you to claim depreciation, even though your property might be increasing in value. This accounting method can be a great ally in reducing your taxable income. 2. 1031 exchange. Named after Section 1031 of the U.S. Tax Code, this strategy allows investors to defer capital gains taxes by reinvesting the proceeds from a property sale into a like-kind property. It's like rolling your gains into your next big opportunity without the taxman taking his cut. 3. Invest in real estate investment trusts. REITs provide a way for individuals to invest in large-scale, income-producing real estate without having to buy and manage properties directly. Some REITs offer tax advantages as they distribute most of their income to shareholders, thus avoiding corporate taxation. 4. Leverage mortgage interest deductions. If you have a mortgage on your real estate investment, the interest you pay on that loan might be deductible. This can be a significant deduction and a good reason to think twice before paying off that mortgage early. 5. Rental property strategies. Renting out a part of your residence or investing in rental properties can create a steady income stream and offer various tax benefits. Expenses such as maintenance, improvements, and even travel to your rental property can often be deducted. Many well-known personalities like Donald Trump have utilized real estate to build their fortunes. Trump's real estate investments have been widely discussed in the context of tax strategies. Real estate is more than just a place to live or an investment. It's a strategic tool that can be wielded wisely to build wealth and reduce taxes. Tax-deferred accounts. In the landscape of financial planning, tax-deferred accounts stand as pillars that support a robust and flexible strategy. The allure of these accounts lies in their unique structure that allows your investments to grow without being hampered by taxes every year. Let's delve into this exciting world of tax-deferred accounts and understand how they can become your pathway to financial freedom. Tax-deferred accounts are special financial vehicles like 401ks, IRAs, or certain insurance policies where the earnings compound tax-free until they are withdrawn. It's the financial equivalent of planting a tree and letting it grow without trimming it every year. These accounts are often associated with employers and offer the advantage of contributions made with pre-tax dollars. It lowers your taxable income for the year and allows your investments to grow tax-free until retirement. The magic of compounding interest works wonders in a tax-free environment. Money that would have gone to taxes remains invested, leading to potentially higher returns over time. Tax-deferred accounts are not merely financial instruments. They are tools for future security and wealth creation. By strategically employing them, you can align your financial goals with tax efficiency, creating a synergy that resonates with prosperity. There you have it, our comprehensive guide to never having to pay excessive taxes again. If these strategies resonated with you, don't hesitate to hit that like button, and let's keep the conversation going in the comments below. What's your take on these strategies? How are you planning for your financial future? And don't forget to subscribe for more content like this. Here's to your financial success. Thank you for watching, and until next time.